So I'm super excited. Welcome everyone to Vyzer Visionaries. We do these webinars to bring more insights into our investment world. I'm Litan Yahav, the co-founder and CEO at Vyzer. In addition to helping people automate and track their wealth, it's really important for us to also bring more knowledge base and tools to make better investment decisions. So we do these monthly webinars with industry leaders across different industries. And today's guest, I'm super excited, is Bob Fraser. He's the co-founder and CFO at Aspen Funds. He's also a reputable historian and financial professional and economist. And so I'm super excited to talk about investment megatrends. Just some housekeeping. This is a live session and it's open to chat. So if you guys have any questions, feel free to drop it in the Q&A. We're also recording this and we'll be sending it to everyone who signed up and registered. And posting it on social media, both ours and I guess Aspen as well. So without further ado, Bob, it's such a pleasure to have you here. Thank you for joining us.
Looking forward to it. So yeah, you and I had a great time at in Denver at an event and had some great combos. And so we're gonna have a fun little discussion here.
Yep. I asked you some hard questions and you gave me some good answers and I was really impressed. And so yeah, we need to
All right, I'm going to go and share my screen here and share some slides. So assume you all can see that. All right, a little bit about me. As he said, I'm Chief Financial Officer at Aspen Funds, 20 years experience in finance. I actually started at .com in the late 90s and raised $44 million in venture capital. Background as a computer scientist. So I'm a total nerd. Love studying, love numbers, love learning. And, that's my background. There's my world. Those are my 9 princesses. So that's my grandkids, literally. So give you a sense of my world. As I said, I started at .com in the late 90s and lost everything in 2001. So my greatest claim to fame, Litan didn't mention, which is my crater is bigger than your crater. So if you think you've had it rough, mine was worse. So I was worth several $100 million. We had 300 employees. Our revenue was doubling every 3 months, sustained for a few years. And won the Ernst & Young Entrepreneur of the Year award in 2000 and then lost everything in 2001. Well, what did I learn? Number one, follow the tides. And you can see the picture here. It didn't matter how crappy your .com was in 1999, it went up, right? And it didn't matter how great your .com was in 2001, it went down. So what did I learn from that? Timing is everything. Understanding what the trends are. And that's the genesis of everything you're about to hear. It's way more important to know what time it is, even than to pick the right investment boat, if you will, right? When the tides come in, all boats float. And the tides go out, all boats drop. And that's that. So it's really important to understand the tides. And that's why I do what I do and why I'm passionate about this. And for 20 years, I've studied markets and timing for this reason. The other thing is go private. I hate the public markets. So I'm about private alternatives. And I'll give you an example here. So, you want to buy real estate. Let's say you want to own commercial real estate. Well, what do? Most people, let me buy a REIT, a real estate investment trust. You do that in the public markets. Here's some of the top REITs or some of the largest REITs. Let's look at, equity residential. This is apartments REITs. And you can see a PE of 21 and a price to book of 2.27. What is that? Why does that matter? Well, a price to book is the book value is the value of the real estate. And the price is the price of the stock. So literally for $1 worth of real estate, you're paying $2.27. Anybody excited about that? Litan, you excited to go run out and pay double?
Yeah, no, 100% no. I mean, I think this is super relevant and important. I think,
don't realize this stuff.
People would argue, and this is sort of where I counter argue that, but would argue, yeah, but the REITs, these publicly traded REITs, they have liquidity.
Great.
Obviously, I think
that's a hell of a price to pay for liquidity.
Exactly. I agree. Also, yeah, I mean, the fundamental aspect of this is, the way I see it is, the price you're paying for a traded share not usually has nothing to do with the value of the underlying asset of that share.
That's my point. That's
Right.
my point. And here it is. So this 227 number, it'll go up and down. You can see it'll go up to 16. You want to pay 16 times the value of the real estate for real estate? It'll go below 1. Now, if it goes below 1, that's the time, forget private real estate, buy public, right?
Right.
That means you can buy $1 worth of real estate for 50 cents or whatever it is. Well, that's the time you want to do it. And they do that. By the way, these all went negative in 2008, 2009 timeframe. And that's the time you want to do this, but it's a very short amount of time. And the point is, though, that number, this multiple just goes up and down because this is a public auction, right? It's a public auction that's not based on data. It's based on sentiment and narrative. So we want to, and here's another example. In 2001, Amazon was 35 cents a share.
Yeah, that was a good time to, right?
Yeah. So, all right. So a little bit more about Aspen and what makes us different. We're not like a lot of, private equity funds. We're more like a hedge fund in that we think first about the trends, the macro trends and the timing. Then we identify the best asset classes and strategies to play those trends. Then we figure out how to place capital. And we co-invest in every deal we do. So we sponsor deals, and literally me as a partner, I put in my own money and I put it in at the same terms as the folks, anybody who's investing. So we eat our own, we eat the dog food we're making. And, like I said, we're passionate about understanding the timing and the trends. Doesn't mean we get everything right all the time, although we have a very good track record. We basically right now manage about 200 million investor capital, about 500 million assets under management, 11-year track record, and we've made 50 million in distributions. So we're super pumped about that. Our team is also, kind of along with our theme, is very different than other teams. We're not just multifamily guys or storage guys. We have hundreds of years experience all told in hedge funds, venture capital, distressed debt, development, all kinds of real estate, oil and gas, private equity. So we've just got a huge breadth of experience that really, helps us make good decisions on these things. All right, enough about us.
Hold on, I have a question, but I have a question. All right.
Yeah, sure.
So there's, this common debate around asset classes and what these mean, right? Because I want to focus on hedge funds for a second, because I've heard so many people considering hedge funds to be something different. Now, let me just say the way I understand what a hedge fund is, and I'm curious, like what you like, how you define it. So obviously, hedge fund is something that hedges the market. In order to hedge the market, it needs to be traded in the same market, and so these are publicly traded positions that have that when the market goes up, they go up less, and when it goes down, they go down less. But the fundamentals of a hedge fund, it's based on public positions. Is that accurate?
Yeah, not exactly. It is based on public positions almost entirely, although sometimes they use currency swaps and other things that are,
well, that's public, but that's public as well, right? That's public as well.
Semi,
Right.
semi. But they are public positions, but they can go long and short. I mean, really what defines a hedge fund means it's unregulated. That's what it means. So they can pretty much do what they want, but you can short stocks in some hedge funds and like that. And they're not designed to be less volatile than I think some of them are designed not to go down when the market goes down, but all of them want to beat the markets. And honestly, the returns of hedge funds in the last 10 years has not been that great. They generally have underperformed the market, and it's 100% manager, right? It's 100% the skill of the manager. Is this guy know what he's doing or not? And even the guys. So if you saw the movie like The Big Short, and
yeah.
Burry and these guys, they haven't done that well a lot of times. They had one good call, they had one good call during the crisis, and kind of that was their moment. And then they raised billions of dollars after that, and it's been mediocre, So hedge funds tend to do better in times of higher stock market
But
volatility.
then that's not a hedge, isn't it? It's like, it's like,
Right.
is it,
I think you should think of it not as a hedge. Think
but
of
it's a
it
hedge fund, but
as
it's a hedge. All right. I understand. All right. I won't go. Let's
it's
not go
just a
down that
word.
rabbit hole.
It's
All
just
right.
that's
All right.
not really what they are.
Okay.
And there's lots of different strategies. There's arbitrage. There's
Right.
global grow.
Okay.
There's pre-IPO. They think a company is going to do an IPO or get bought, and they'll do arbitrage ahead of time. There's all these different strategies that all work or don't work, depending on what time
But
it is.
isn't pre-IPO private equity then? Because it's pre-IPO. You're buying a
Yeah,
private company that will, so that's
right,
private equity.
right.
All right.
They'll take
But
positions in shares that they think are going to be bought out, right, based on the news and
right.
you,
All right.
you
Let's
name
not
it. They're
let,
trying to
let,
get an edge. They're trying to get an edge, and it's the whole. Just think of a hedge fund as unregulated public portfolios by
right.
super smart guys. Right, that's what it is.
All right. We can dive into this at some point, maybe later. I have a
Well, that's
lot.
fun. It's good
Right.
combos. All right. The big surprise: no recession. Right. So that's the big surprise. No recession so far. And here you can see the GDP. This is real GDP. Where is it? There it is. So you can see real GDP is the blue, and you can see the interest rates, the Fed funds rate going up here. And then what happens? So they start massively raising the rate, but look at GDP continues to grow and accelerate. So what the heck is going on? The yield curve, which has been super accurate since 1955, right, says whenever the yield curve inverts, it means there's going to be a recession. And inversion means, so we all think of, if you invest your money for a shorter period of time, you get a lower interest rate. If you're going to go a longer period of time, you get a higher interest rate, right? That's called a normal yield curve. When it inverts, it means the longer you invest for, the lower your yield is. Well, and that means for a lot of reasons, suppose we're going to have a recession. Well, it's been inverted since October of 22. And by the way, we called that's the yield curve is lying this time. It's not going to happen. It's not going to signal. Longest inversion ever and deepest inversion since 1900. So what happened? Bottom line is the consumer happened. The consumer happened. Wall Street Journal. What recession? Growth ended up accelerating in 2023. Economy expanded 3.1% due to strong consumer spending. There it is. The consumer happened. So who knew? Who knew? Who knew? Well, this is from a presentation I made a year ago. So is it okay, Litan, to toot my little horn here? And, there it is. Strong consumer spending, no recession. It's like, and I said, this is exactly what's going to happen. And by the way, I was calling it 2 years ago. This exact thing. It's not going to happen. We're not going to have a recession because the consumer is too strong. So what the heck is going on with the consumer? What happened? Well, and it matters because 70% of the US economy is consumer spending. So we live in a consumer spending economy. That is the US economy is 70% driven by human beings buying crap. This is insane. This is one of the most crazy charts I've ever seen in all my data studies ever, right? This is the households and nonprofits check deposits. And look what happened. It's grown by $4 trillion, 400% from normal.
Why is it important to look at the nonprofits within this graph?
It's just the way they break it down. It's, it's not businesses. It's not.
No, because you look at, I don't know, you look at, the Harvard Endowment, is that a nonprofit? And it's probably sitting on.
That would be, but they don't have 5 trillion sitting there. So yeah, okay. I mean, I don't know how it breaks down. I have not seen that data. They don't break it down. You can't get more granular data than this. Okay. But what happened is just incredible amount of cash money sitting in checking accounts right now. Consumer spending. So here you see, this is the great financial crisis down here and the Obama recession here, but you see consumer spending, ticking up until COVID, of course, took a massive crash down. And then look what's happened since then, a hockey stick. And it's literally from the end of COVID, up 35% consumer spending. So consumer spending was already doing real well, and then just did this. What is going on with consumer spending? Consumer savings. So we saw COVID, huge amount of savings happening during COVID. And why? Because what's obvious, people didn't go out, right? And then now it's come down since then. It's actually at a lower level here because of inflation, but consumers are still sitting on savings. Consumer debt, this is the delinquency rate. This is the percentage of people who are struggling to pay their mortgage. All-time record low. This is, of course, the great financial crisis. And you look at, this is household debt service. This is debt service here as a percentage of personal income, of disposable personal income. So you can see right now, how much are people paying to service their debt is actually quite low. Why is that? How explain that in an era of high interest rates? Well, mortgage, a lot of people are sitting on 3% mortgages. And this upper chart is total household financial obligations. This is all the bills that you have to pay as a percentage of disposable income, and it's at an all-time low. So the consumers are just healthy. They have low delinquency rate, debt service is low. Here's the wealth effect, and this is household net worth, and the blue line is household net worth, and the green here is real household net worth, meaning after adjusting for inflation. Why does this matter? Net worth matters because, so net worth, think of it, this is primarily the value of your stuff, including your home equity, and your stock market portfolio. So generally, if home prices go up and if stock market goes up, this increases. And if you feel rich, right? If you look at your bank account, Leighton, and you got 6 zeros in there, and you're feeling good, right? So this is what happens. And look at this, again, very similar to the consumer curve. It took this hockey stick curve up, and real net worth is up 11% after adjusting for inflation since 2019. So people feel wealthy. So what's going on with the consumer? What the heck is going on? Well, maybe you know the answer. The stimulus, why we are where we are. And I'm not going to hit a lot of this, but most of this, we had actually 16 trillion in global stimulus. If you count the direct stimulus and the support, the banks monetized $11 trillion in debt, meaning they bought debt. They printed money and bought debt. Very, really creates a lot of money in the system. And here's the key point I want to make is that this stimulus was different than every other stimulus ever done in history. Very, very different. They did things that had never been done in history before. And so stimulus, for years, the stimulus was, hey, let's lower interest rates. And the problem is, so lowering interest rates primarily to appeal to businesses. Like if you lower interest rates, well, now I can make, Leighton, you can go and hire your new marketing firm and you go double the size of your staff and go sell more software, right? And you can borrow money to do that, build out your factory, right? But what if your business is on its, what if your business is suffering? Are you going to want to go expand your factory and borrow money to do it? No.
Probably.
Yeah, even if they give you 1% interest rates, you're saying, I'm sorry, I'm not going to do it. That's the problem. So lowering interest rates is like pushing a string. It's not that powerful. It has a long-term effect, but it takes a while and is not direct. Well, so come 2008, and I believe had they not done what they did in 2008 and 2009, we would have had a Great Depression, another Great Depression. And so this was extremely serious. And they had a couple new mechanisms. They actually did direct debt and equity injections. If you remember AIG and the TARP program, they put money into businesses and into situations. And then they also did this whole brand new thing called debt monetization. It had never been done, where they literally bought the government debt. They printed money and bought debt, 3.6 trillion over 6 years. Now, at the time, I was an Austrian economist, a hard money economist, and I believed that this was going to be hyperinflationary. And if you're around in that time, I mean, I was ready for it in 2009. I was sure we're going to have hyperinflation, debt monetization. Anybody remember what happened inflationary wise from 2009 on? I mean, it was below 2%. So I ditched my Austrian economics. I'm no longer an Austrian economist. But this was a huge amount of financial innovation that happened. Well, what happens is innovation tends to beget innovation. So what's good then? Well, next time we have a crisis and COVID, man, let's innovate some more. That was so good, you know? So they did, instead of 3.6 over 6 years, 5 trillion in 2 years of debt monetization, a massive amount of debt monetization. And then they did something that had never been done in history: direct payments to individuals. They basically sent people money. Okay. And, you know, and just for the sake of argument, let's say I wired to every single person in America $1 million, right? The government did. What's going to happen? People literally have $1 million in their bank account. And just for the sake of example,
Right.
well, they're going to go spending, going to go shopping. They're probably going to quit their job, go buy crypto, right?
Yeah, basically $1 million doesn't mean
exactly what we saw happening.
Basically $1 million doesn't mean anything anymore if everyone has $1 million.
Well,
it's not worth it.
I would tend to argue with you on that. I think to a lot of people, you know.
No. I'm just saying, if everyone has $1 million, then the currency isn't worth.
Agreed, but
right?
it wouldn't change anything. People would still go shopping and go, you know, leave the workforce, go buy crypto, go, you know, invest in Robinhood meme stocks.
Yeah.
And this is exactly what we saw happening. So it was really the stimulus that had never been done before. And it was, you know, and exactly what we saw. So here's this consumer spending chart again, and people exiting the workforce. This is the participation rate, which is the percentage of the population considered in the workforce. And you saw basically here at COVID, you know, really took a dive. It's exactly what you see happening. So why is this one inflationary?
I have a question just before that. Sorry to interrupt. On the previous slide, just on the employment rate or the exiting the workforce, the COVID pushed a lot of people towards, you know, the so-called gig economy. Let's just, you know, either on social media, content creation, or any other gig economy.
Uber, right?
Whatever. How much is that? How much do you think that affected the exit of the workforce versus the fact that they had money and they didn't feel like they needed to work?
Well, there's still a person who's doing Uber is still considered in the workforce. So a lot of what happened is people took retirement. So, you know, a lot of, you know, you look at the airlines, they retired their pilots, and the pilot said, okay, I'm out of here. I'm almost retirement age anyhow. So you actually see a lot of this is demographically related, but also people just took advantage of the extra cash and exited the workforce. All right. So this is a key chart. Okay. This is a key chart. And I want to show you, we have the two big crises. So this is the 2008 crisis here. And you see, these are the big stimuluses that were happening. One, Bush, and this is the industrial capacity utilization. This is the percentage of how busy the factories are. So the higher number, factories are busy. Down here, factories are idling. Make sense?
Yep.
So, and this is just a proxy. I'm oversimplifying, but you get the idea. So what happened? So Bush did this right as everything was falling like crazy. Awesome. Obama bottom ticked. It's like just as things were really getting ugly, he bottom ticked, and they did the stimulus. And guess what happened? Inflationary wise, nothing. So when I print money and to create artificial demand, which is what stimulus is, at a time when the economy is idling, it's not inflationary, right? So if I've got a factory and I'm at 50% of my orders, or, you know, I'm only operating 50% of my capacity, and I get some orders from the government who printed money to buy some stuff from me, I'm going, you know, I can ramp up production. It's not inflationary. Okay. But then look at what happened here. So the next one. So this is COVID. Well, Trump does, again, perfect bottom tick, a very, very big stimulus, 2.3. He did another one here as the economy was rising. And then here, this one was a huge disaster. $1.9 trillion by brilliant Biden at a time when the economy was already at capacity. If you remember this, there was already the economy, we already had supply chain problems. We couldn't even manage existing demand. And then he goes and creates artificial demand on top of it, right? So now if I'm at 100% capacity as a factory and I get 50% more orders artificially from the government, what am I going to do? Well, I have to hire people, I have to expand shifts, I have to buy more equipment. You follow me? It is inflationary,
Right.
Because I've got to go and buy more stuff. And so this one was an absolute disaster. It was pure politics, and was an absolute disaster. And that is inflationary. So it matters. Not all money printing is inflationary. This is where I differ from the Austrians. It's not. And I can show you in history, it's not. It's proven. It's not inflationary, but it's the matters when you do what you do. So, you think about it, I'm a student of the Great Depression. And in the Great Depression, you think about it, a guy loses his job. Well, then he stops buying stuff. And then when he stops buying stuff and the businesses start to go down, well, then people lose their jobs. And when people lose their jobs, they stop buying stuff. And it's this vicious cycle that doesn't stop going down until you create artificial demand. And that's where I believe this. So the government then to step in and print money and create artificial demand to help people get their jobs back, and then they can start spending, and then you get a virtuous cycle. And that's exactly what.
But hold on. If there's no demand, prices go down, right?
Of course.
If there's extreme demand, prices go up. And so when people don't have money, that's, deflationary or whatever.
Deflationary. Yeah.
Deflationary.
We're talking about the economy here, not
Right.
inflation.
Yeah. Okay. I guess that makes sense.
Yeah. Yeah. So what happened when there's, if you've got a little business and in order to fulfill this new order I got to double my staff. That's inflationary. I got to go try and hire people in a market that I may not be able to. I got to buy goods when they may be inflated, and it's all inflationary. But when my factory's sitting idle, it's not inflationary. And that's what this blue line is. It shows how busy is the economy, how much capacity. So anyhow, it's clearly stimulus is the problem. So what megatrend one, inflation. So we've seen the worst, but not the last. This is the PCE, which is what the inflation index that the Fed looks at, and we're at 3.1% right now, or about 3% for their core PCE. You can see it spiked up and is coming down quite rapidly. By the way, they just printed the numbers today for the not the PCE, but the CPI, and it's more stubborn again, But the Fed's goal has not changed. They're saying they want inflation under 2%. Okay. And I like reading this quote because I don't think people are reading the quotes that what he's saying. I mean, there was we just did a little top of mind podcast today, Ben and I, and it was on a Wall Street Journal article that showed how the markets always misunderstand or always misconstrue the Fed's intentions. And right now they continue to say the Fed is going to bring rates down, and rates have continued to go up, and how wrong it is. And the market watchers have been wrong on inflation. So I'm going to read this. Changing our inflation goal from 2% is just not something we're not thinking about. And it's not something we're going to think about. We have a 2% inflation goal, and we'll use our tools to get back to 2%. I think this isn't the time to be thinking about that. I mean, there may be a longer run project at some point, but that's not where we are at all. The committee, we're not considering that. We're not going to consider that under any circumstances. We're going to keep our inflation target at 2%, and we're going to use our tools to get back to 2%. Anybody think he's targeting 2%?
Yeah. And the tools he's going to use.
And he's going to use their tools. And by the way, we're not that close. So 3% is still 50% higher than 2.
Right.
Now, if it keeps coming down, I think we're okay. But and he's not saying as soon as it just almost gets to 2%, we're going to lower. Okay, I don't think they are. So we can get to my inflation outlook and the Fed's outlook, but they're going to want to make sure that inflation is dead before they do it. They're not going to want to, as soon as it ticks and then they lower interest rates, all of a sudden it re-energizes everything. They do not want to do that and have a double take. So they're going to take their time.
When you say they're going to take their time, they're basically going to take their time bringing interest rates down.
Lower rates down. Yep. Not in any hurry. Okay. But inflation is the key, right? We got to look, because if that's what's going to cause interest rates, and that's what is the big pain point now. Well, what is it? There's 2 dirty secrets, and I've never seen people talking about this, but there's 2 dirty secrets underlying inflation. It's the hidden ingredients that are of inflation that are in underlying all of goods and services, but it's not talked about. And these are not components. So labor is not a component of the CPI or the PCE, but it underlies everything. Think about what good or service doesn't require labor? Very few. And the other is energy. And I want to show you here. This is the employment cost index, wages and salaries, and you can see it hugely spiked up during post-COVID. That's the labor side. Well, what about the energy side? Well, okay, this is the CPI. The yellow line here is CPI. The black line is oil price. And I want to show you most of the inflation that we had from 2020 on was due to the oil price. And most of the easing in inflation we had post is due to oil. And why? Well, because oil underlies everything. What good or service doesn't require someone to hop in a car or drive a truck or heat a house or a building? That energy is the mother of all commodities. To make steel, to harvest a wheat crop, it's all diesel. To make a windmill, a wind tower, you've got to, it's all iron ore, and then it's all run by diesel and then shipped, and then smelted, all coal, and then erected by a diesel crane and maintained by a diesel, or a pickup truck. And the truth is, oil is underlying absolutely everything. And these things are the 2 main drivers of inflation, which is why I believe that inflation is going to stay higher, because these 2 things are under a systemic pressure right now, not a cyclical business pressure. There's actually underlying reasons why these are high. And I'll talk about that a little bit, but inflation is good news, bad news, right? It's a wealth creator and destroyer. So, I'm sure Litan, you buy an apartment complex, and inflation really is your best friend, because if your rents double over 10 years, which at 8% inflation, by the way, that's exactly what happens at 8%. Its prices double every 10 years. And well, that's good news if you're a guy who's a landlord, right? And the cost of stuff drops. The value of a dollar drops by 50% every 10 years. And so that's good news or bad news, right? Inflation, as I've said, is the greatest transfer of wealth in history. And it's a transfer of wealth from savers to borrowers, because it eats the value of a dollar.
Right. So and you want to hold real assets.
You want it. That's right.
To hedge against inflation,
or anything that can be adjusted for inflation. So, real assets. So like gold, gold has actually been a lousy inflation hedge. If you look at the last 50 years, and I have slides, I didn't put it in this presentation, but I can show you that gold has underperformed inflation every decade for the last 5.
Yeah. So, I wasn't even thinking about gold as a real asset. As funny.
Okay.
It's more commodity than it is an asset.
Yeah. Well, and I would say income producing real estate, especially if it has price, if you can adjust your prices to inflation. So pricing power, it's called having pricing power.
Right.
So, So in rents, you certainly do have pricing power. All right. So what about these two things? Well, the wage pressure is going to continue. And think about if consumer spending is still here and you have high demand, right? And people exiting the workforce, and you have this jobs gap. So this is the jobs gap. This is the unemployment level right here. This is the job openings. We still have more job openings than people looking for jobs, right? Now, a lot of it is this gap, in in skills. So, but it's this jobs gap is not going away. And then, of course, recently, just a recent article, job growth blast past expectations. So the wage pressure is going to continue. What about energy? Okay, this is the second inflation secret, right? Well, coming energy crisis. Okay, Bob Fraser is announcing to you, right, a coming energy crisis. And this again is not highly followed by the mainstream press, but this is a very, very, very big deal. The truth is, production from existing fields declines 2 to 5% every year due to depletion. Okay, this is just normal. There's a decline curve. Okay, no surprise there. But what it means is every year we need about 5 million barrels per day of new production, meaning new drilling that finds oil to the tune of 5 million barrels per day of new production to maintain a flat supply. Okay, again, that's just normal. But what happened is since 2014, global spending in new exploration and development is down 55%. We have a major problem. So what's happening is people have quit spending the money to develop oil and gas fields. So this is a crisis in the making that is massively brewing, and it's about to hit. People think of, and this is the popular narrative, well, we're going green. We don't need oil. That's exactly why people have been underinvesting. But this is the truth. Today, all fuels you look at are 83% carbon. Non-carbon is 17% of everything. And so nuclear 32, hydro 41, wind 17. It's still, after 40 years of going green, we've managed to get 17% decarbonized. And you think about it, I mean, it makes sense. As I just said, the windmill example, to make your windmill, you're going to have to, mine iron ore. It's all diesel. You're going to ship it with fuel oil to China where it gets smelted, and then the smelting runs coal, and then you're going to ship it back. The pig iron, running fuel oil. Then you're going to forge it running coal, and then you're going to transport it on a truck running diesel, and then you're going to erect it on a crane using diesel, and then you're going to maintain it by a pickup truck using gasoline, and it just takes 80 gallons of oil a year to run that windmill, just to lubricate it. So people have the math. No one's done the math here. No one's done the math. People think EVs are the answer. But last year, 5% of vehicles sold in America was electric vehicles, and they use 65% of global lithium production. Anybody see a problem with that?
Yeah.
And what's more, they said just to meet the Paris Agreement, we need 40-fold production in lithium. 40-fold by 2040. Never going to happen. There's, not to mention the fact that all those lithium mines are going to use use coal and diesel. So it's just people have not done the math. Bottom line, JP Morgan is predicting a 7.1 million barrel per day shortfall by 2030. That is no joke. But
here's a question. So as per, previous, I don't know, like a few minutes ago, talking about inflation and prices and high demand or supply affecting prices. If there's such a low amount of stuff, like a small amount of supply, that should create a situation where prices should skyrocket already.
Right.
But they're pretty normal, like over the past few years. Like they were high, They were low, nothing like.
Well, there was hitting over 100 a barrel.
Yeah, but that was only like for a few months. That wasn't like something that.
Right.
Why is that?
Right. Well, there you go. Delayed.
Okay.
So good call, Liton. What's going on? Why it's been delayed, and primarily because of China. So what's happening? China is the marginal. So you realize China does not produce their own oil; they only consume. And China has been in the doldrums. So they have basically um, consuming large amounts of oil. So they're the marginal consumer is what's happening, and they have not. And the reason is they are in deep, deep, deep trouble. So we're going to talk about the China apocalypse right now. And again, this is not something that is on people's radar. I mean, most people still think that China is about to take over the world, and they're not.
Hold on. So just before we dive into this, I just because like a quarter two, and this is really interesting. I don't want to stop you. I just want to get just like remind our audience that if you have any questions, feel free to write them down in the Q&A or even in the chat. All right, go ahead.
Yeah. So 2023 was the year China was supposed to roar back, and they didn't. They're seeing slowing growth, soaring unemployment, deflation, falling exports, property bubbles popping massively. They have a 25% of their economy is property development, and it's collapsing. They're supposedly, it's hard to get real data, but 50% of the apartments are vacant. And they can't cut rates for a lot of reasons. Their crackdowns in private sector has soured business confidence. They're in deep, deep trouble. And what's more than that, they're in the middle of a demographic complete and utter collapse right now. This is the UN population database, and they're showing the Chinese population dropping by 50% by the end of the century. 50. Actually, the numbers now coming out, not from the UN, and Wall Street Journal just printed an article on it today, 2/3 less population. And the workforce, the amount of workers is dropping by 2/3. And the latest numbers are showing as much as 3/4 of the workers gone. Imagine 75% of the workforce had disappeared. And if you don't think this is tectonic, you're not paying attention. How can they be a manufacturing power? How can they be a war power? How can they continue to how many iPhones are they going to need? How many smartphones? How many cars are they going to need? How many more apartments are they going to need? The problem is the economy is based on population. So the size of the economy is population times productivity. So we're seeing a huge shift happening in China.
Crazy.
We're seeing deglobalization as the fourth trend. So we're seeing the world shifting from globalized economy. Just case in point, the red line here is China's manufacturing rate. It's gone up 15-fold since 1999. China's actually more expensive to produce than Mexico right now, which is the green. And this is the percentage of GDP that's trade, and you can see what happened. It actually peaked in 2008. So trade is actually diminishing, and the trade has been trade has been increasing in its value to GDP since 1945. So this has been a huge shift, and we're seeing the world deglobalizing now and going more and more local. I'll just going to hit a few more points here, just real quick. Megatrend 5 is the industrial boom stage 2. So this is based on this deglobalization trend. We're seeing huge amounts of reshoring. So a business is coming back to America. And I say stage 2, we've already seen a huge industrialization of logistics due to e-commerce, but now it's happening because of manufacturing. Look at the construction and manufacturing facilities. Look at this. Here's the manufacturing job announcements per year.
Is this the US or is this global?
Just US. This is all US data. So you're seeing companies are hugely wanting to bring manufacturing back to America. And if you actually look at costs and you count robotics, tariffs, it's actually can be cost competitive to manufacture in the United States. And certainly if you count energy, America has lower energy than anybody. Our gas price now is $2. I think in Asia right now, it's over $5. 2.5 times more expensive. So, and energy, as I said, is a huge driver. Some of the reasons people are moving, I'm not going to get into all that. We see, so Aspen's way we're playing this as Aspen is we're doing new construction development of big box industrial facilities. And we're seeing huge amounts of construction starts falling in industrial, and incredible, vacancies dropping and market rents rising in industrial. I'm going to go ahead and skip this. Number 6, the multifamily meltdown. So I don't know how familiar some of your listeners are, but we saw a real bubble, a mini bubble in multifamily financing. A lot of these smaller operators going and buying multifamily places, they get too much debt, and they got variable rate debt. And then a lot of times they put private equity in it in addition, and we're seeing a huge problem. Now, the good news is long-term, there's demand. We see high household formations. We see chronic underinvestment in housing. So a lot of demand in housing. But debt costs are up 75%, operating costs up 8.3%. Vacancies are up, rent growth is down. And in the midst of all that is record deliveries of new apartments. Look at the deliveries of new apartments. It's insane, 23, 24, and 25. So we have in the midst of all this bad economic news, we've got huge amounts of new apartments being delivered. And supposedly, according to Newmark, 59 billion in troubled multifamily debt maturing in 24 and 25. So 22% of maturing loans have a DSCR. That's wrong, below one. And 35% of maturing multifamily loans had originating cap rates below 4%. So these things, they way overpaid, and there's not enough cash flow. These things are they're bugs looking for a windshield.
So I have a question about the debt, because it's really interesting and important. Why are we separating the effect of these variable debt only to like multifamily and not to the whole commercial real estate?
Because multifamily is where most investors are. I just chose to highlight that. But no, it's across the entire space. I mean, I could hit on office, but a lot of the listeners that I speak to don't buy office space. But office is in a total apocalypse right now.
But that's from a whole different perspective. I'm just saying, from a debt perspective, every variable debt operator is going to face 100%. The same issues.
100%. And I could have pulled the CRE charts, but I pulled the multifamily charts.
No, it's all right. I just want to emphasize that. All right, cool.
Yeah. No, 100%. No different. So, bottom line is we're seeing still not a lot of price discovery in 2024. We're seeing operators continue to try to kick the can down the road, extend and pretend. But this is really going to be coming due. We believe the best market is going to be in rescue financing for 2024. And we're actually starting a rescue debt fund. Aspen is. So, yeah. And I believe buying opportunities will persist throughout the year and throughout next year. So, but you want to make sure you get good deals, and I think they'll be coming, but they're slow to come right now because we still see the bid-ask spread too high, right? The sellers aren't ready to come down to what the buyers are willing to pay, and the buyers aren't willing to come up to what the sellers want to get. So we'll see. But it's a good opportunity.
Are you still think is it still frozen like that? Like the buyers don't want to sell?
It's easing slightly, but still pretty frozen. Yeah. Okay. So we said it's a great opportunity to go down the capital stack into less risky positions. So where you're doing mezz debt or senior debt or preferred equity and stepping in front of the common equity, and you can get equity-like returns right now for debt-like risk. So we think it's a wonderful bet. And the last one I'll hit today is neighborhood retail. Just throw this in. Retail spending, remember, is on fire. We've seen, Wall Street Journal has been hitting on it over and over. Hottest real estate plays in your neighborhood. You're seeing huge migrations happening from the urban cores to the suburbs. And you're seeing strip centers, these little neighborhood centers, just being absolutely full. They've been, retail real estate, it's its biggest revival in years. decline of the 5-day commute as a boon to suburban retail is a huge move, and retail has been massively underinvested in. We're seeing retail space is actually declining, the space per capita of available space, and we're seeing market rents, vacancies going down and market rents going up consistently. We're actually buying these things at a 9% cap rate, believe it or not, and they're 100% occupied, and we're buying them at 50% of replacement cost. So it's just hard to imagine losing money when you're buying something like 50% of replacement cost and a 9 cap. That means 9% cash flow unlevered. It's like nuts.
Yeah. All right. Yeah. Well, let's do. Yeah. Well, there's so much interesting stuff. I don't even know if to stop here or not. This is great.
Well, and
Keep on going.
This is the last
All
slide
right.
I'm going to show is just Fed watch. And I kind of said this, but I think tending towards lower inflation as the China apocalypse is going to be disinflationary. And I also think we're going to see the rents component of the CPI is a lagging indicator, and we've seen rents continue to come down. So that's going to be pressuring the CPI numbers to be lower. On the higher inflation side, we have a strong job market, increasing wages, and a hot economy. So bottom line is I don't see the Fed lowering rates this year unless I get surprised. We see massive 2% inflation numbers hitting soon, and which I don't think we're going to see for reasons I just said. But I believe the Fed is going to want to wait and for a while to see the market soften before easing, and they're just not going to lower rates. And I think if they do, they're going to be accused of being politically biased, right? And I don't think they're going to want to do it. So that's it. And just a little pitch for our Invest Like a Billionaire podcast, which I know Litana has watched just a few episodes, and it's a award-winning top 5% of or top 1% of all podcasts. And sign up for Investor Club if you like to have some deal flow and see what Aspen is up to.
Actually, I also had the privilege of being on the show. Ben interviewed me there a few months ago.
Yeah, that was good.
I had a good time. Yeah. So listen, I guess there's time for like one main question, and it's for me. I think it's a big question, and I hope also for everyone else. And I mean, you mentioned this, but I want to dive deeper into it because a lot of this depends on the fact that consumer spending will continue to be strong. And it seems to me the main indicator on that is just because they have a lot of cash. Is there anything else you really think like that there needs to be an end to that at some point? What will bring the end to that spending?
Well, but it's all those things, right? It's wealth effect, which is stock market and housing prices, which I believe because of inflation, those tend to go up, by the way. The best performing asset in inflation is actually single family homes. The second best is the stock market, believe it or not, because they have pricing power. A lot of these, think about Procter and Gamble. Your diapers are going to cost more if inflation. So they're going to continue to go up. You look at, that's the housing prices, stock market. Well, that's wealth effect. You look at, real income. Is real income going to go up? Real income after inflation, and it has been. And yeah, if the job market continues to be troubled and short, if there's low inflation or low unemployment rate, heck yes. The jobs gap. So those things continue to drive wages up. So it's not just it's wages, it's wealth effect, it's a lot of things that continue to drive it, not just cash. So if you feel like you're earning a lot of money, you got raises, well, you're still going to start spending. So at some point it will end, and I'll tell you, when I see the signs. But right now, there's not a lot of negative signs right now, and it has been this way for over 2 years. And I've been saying the same thing for 2 years now. At some point it'll end, right? And that cash will work through the system and these things. But we got a minute before that's going to happen.
Right. We have another question here. If there are any comments on global liquidity looking to be cycled up until 25, 26?
Say again.
Are there any comments on global liquidity looking to be cycling up till 25, 26, 2025, 2026?
Yeah. I think global liquidity has been cycling up, and I think it's going to continue to be cycling up. I mean, you look at and the debt monetization, that has been done globally, 11 trillion is still in the system, plus the 5.7 trillion from the United States. So I think we're seeing a lot of liquidity out there and is going to continue to see just tons of liquidity.
Got it. All right, so we're at the hour. Bob, I really want to thank you. This has been super interesting for me. And I'm sure for all the listeners and everyone who's going to listen and watch this recording. We have a lot of our clients that are invested with Aspen and love it, and we're seeing really good we've been seeing amazing stuff, and so I'm super excited that we finally got a chance to get you on this call. I also heard you at that other event talking about the same trends, and I learned so much, and I appreciate it, and everything you mentioned here on the call. If there's any questions and people want to follow up, how can they reach you?
Yeah, you can reach me at bob@aspenfunds.us. But yeah, I think it makes so much sense for us to pay attention to these trends, right? It just makes you smarter, right? Just to put your capital in front of the the boats that are going to float, and to understand what's going to happen, and just think it only makes sense to learn these things, and
Right.
not just do more of the same.
100%. All right, guys. So it was a pleasure. Thank you all for joining us. Remember, if you want to keep your passive investments passive, head over to Vyzer. That's what we're all about. Tracking all these great investments in this private equity, hedge funds, real estate, whatever it is. Have a great rest of your day, and be safe.
Thanks, guys.